Italy is the third largest economy in the European Union. It helped shape modern Europe. It produces luxury cars, high-end fashion, precision machinery, pharmaceuticals, and some of the most recognizable brands in the world. And yet, for more than 15 years, its economy has barely grown. Since the global financial crisis in 2008, Italy's real output has struggled to regain sustained momentum. Productivity growth has been among the weakest in the developed world, real wages have stagnated, and public debt has climbed to roughly 140% of GDP. For a country this large, this industrial, and this central to Europe, that is not a minor slowdown. It is a structural warning. Because what is happening in Italy is not isolated. Aging populations, rising debt burdens, declining productivity, political fragmentation, intensifying global competition, and rapid technological disruption are pressures now facing the United States, the United Kingdom, and much of the advanced world. Italy simply encountered many of these forces earlier and more severely. To understand how a country with such industrial depth and global prestige entered a prolonged era of stagnation, you have to go back to the end of the Second World War. Post-war Italy experienced what economists still call an economic miracle. Backed by reconstruction funding, domestic reforms, expanding trade, and strong global demand, the country industrialized at remarkable speed. Between the 1950s and early 1970s, growth rates were among the highest in Europe. Manufacturing capacity surged, infrastructure networks expanded, and Italian exports penetrated markets across the Atlantic and beyond. Living standards rose quickly. But beneath that rapid expansion were structural vulnerabilities. The state accumulated debt to finance development, inflation periodically accelerated, and political instability remained a constant undercurrent. When the oil shocks and global turbulence of the 1970s arrived, Italy was hit with high inflation, rising unemployment, and mounting fiscal strain. Reforms followed, including tighter monetary policy and changes to wage-setting mechanisms, which helped restore stability. By the mid-1980s, Italy entered another powerful expansion, driven by exports and the premium global reputation of made-in-Italy manufacturing. Italian brands commanded higher prices not because they were cheaper, but because they were perceived as better. That pricing power became a defining strength, yet strong growth masked persistent inefficiencies. Public debt continued to build. Tax compliance remained inconsistent. Much of the industrial base consisted of very small, family-owned firms that were agile but limited in scale. When Italy sought to qualify for the eurozone in the 1990s, it had to impose fiscal discipline, reduce deficits, and stabilize inflation. Those efforts allowed it to join the euro in 1999, lowering borrowing costs and deepening trade integration. For a brief period, expansion resumed. But while countries like Germany used the early 2000s to implement sweeping productivity and labor market reforms, Italy's modernization was slower and more fragmented. Then came the global financial crisis in 2008, followed by the eurozone sovereign debt crisis. Italy's economy contracted sharply. Unlike the United States, which returned to relatively steady growth in the following decade, or Germany, which rebuilt export strength, Italy entered a prolonged period of weakness. Since 2008, average real GDP growth has consistently trailed much of Northern Europe, and the US productivity growth, the ultimate engine of long-term prosperity, has remained subdued for more than 20 years. One of the most significant structural constraints is demographics. Italy has one of the oldest populations in the world. Its fertility rate is well below replacement level, and the proportion of citizens over 65 continues to rise. That means a shrinking working-age population supporting an expanding retired population. Fewer workers translate into lower potential output, slower tax revenue growth, and mounting pressure on pension and healthcare systems. At the same time, many young and highly educated Italians leave in search of higher wages and broader opportunities elsewhere in Europe or abroad. Within the European Union, freedom of movement makes relocation relatively seamless. For individuals, this mobility can be empowering. For Italy, it represents a steady loss of skilled human capital that is difficult to offset. Business structure compounds the challenge. The average Italian firm remains significantly smaller than the typical firm in Germany, France, or the United Kingdom. Small enterprises can be creative and specialized, but they often lack the capital and scale required for heavy investment in research, automation, advanced digital systems, and global expansion. Larger firms benefit from specialization, economies of scale, and the ability to spread fixed costs across greater output. When an economy is dominated by small, fragmented businesses, aggregate productivity growth tends to slow. Technology adoption has therefore been uneven. While Italy excels in high-end manufacturing niches and design-driven industries, overall digitalization and large-scale technological investment have lagged leading economies. In a world where software, robotics, artificial intelligence, and advanced data systems dramatically increase worker output, delays in adoption can compound year after year. Lower productivity constrains wage growth. Constrained wages encourage outward migration of skilled workers. That reinforces the cycle. Fiscal realities add further complexity. With public debt around 140% of GDP, policy choices become narrow. Aggressive spending cuts or sharp tax increases risk suppressing growth in an already fragile environment. Additional borrowing raises concerns about long-term sustainability, especially in a higher interest rate world. Membership in the eurozone removes the option of independent currency devaluation, limiting monetary flexibility compared to countries with sovereign currencies. Structural regional disparities also persist. Northern Italy remains significantly more industrialized and productive than parts of the south, where unemployment and poverty rates are materially higher. Regional imbalances reduce national efficiency and complicate reform consensus. A sizable informal economy continues to operate partially outside regulatory and tax systems, weakening public revenues and distorting competition. None of these factors alone guarantees decline. Many advanced economies face aging populations. Several carry high public debt. Productivity growth has slowed across much of the developed world. What makes Italy instructive is the convergence of these pressures over an extended period without a decisive productivity breakthrough to offset them. Growth has not collapsed entirely, but it has remained too weak to substantially raise living standards or significantly reduce the relative debt burden. The central question is whether Italy can engineer another structural renewal as it has done in previous eras. Historically, stagnation was followed by reform and resurgence. Today, however, global competition is more intense, capital is more mobile, technology cycles are faster, and demographic headwinds are stronger. Revitalizing growth would likely require scaling firms, accelerating technological adoption, improving labor participation, strengthening tax enforcement, attracting investment, and retaining domestic talent. That is not a short-term stimulus package. It is a generational transformation. Italy's trajectory challenges the assumption that advanced economies automatically trend upward. Over the past 2 centuries, industrialized nations have generally grown wealthier. But that progress has depended on continuous adaptation. When institutional reform slows, when demographics turn negative, and when productivity stalls, long periods of stagnation become possible even in wealthy societies. For audiences in the United States, the United Kingdom, and across the developed world, Italy is more than a national story. It is a case study in what extended low growth looks like inside a mature, debt-laden, aging economy embedded in a competitive global system. The lesson is not that decline is inevitable. The lesson is that prosperity is conditional. If structural weaknesses are ignored for long enough, even large and sophisticated economies can drift. The question is not whether Italy once thrived. It did. The question is whether it can adapt quickly enough to thrive again in a very different global era, and whether other advanced economies are prepared to confront similar pressures before they face the same prolonged test.